The Bank of Canada cut interest rates a quarter point this week, which is the first sort of global major central bank to cut. Now, the Bank of Canada stated that they're likely to cut further if inflation stays under control. Now, this is very good for borrowers, but the Bank of Canada, like many other central banks, is in a tough place because if they cut here too early and inflation keeps rising, they've got a real problem because fiscal deficits are huge. If interest rates rise, it means the borrowing costs for government go up, and this could create a real problem. So it's nice for people that are indebted, but we're not necessarily out of the woods yet on the inflation front. For example, Japan is in a terrible position where their inflation is just shy of 3%, and their debt is so large that any rate hikes they make could put tremendous pressure on the fiscal deficit. So we will see what happens. The markets reacted favorably with the bond market rallying and the Canadian dollar coming off somewhat. So we'll see where this goes. Over the past several weeks, we rebalanced the permanent portfolio. Instead of waiting until July, with gold and silver up so much, we decided to take the gains. So you'll see that on the statement showing that we've rebalanced the portfolio. Now, we're not necessarily done because come July, it's quite possible we will be moving from the short-term bond into the Treasury ETF. In a sense, we're going back to the original origins of the permanent portfolio where you had a 20 to 25% cash position. We substituted short-term bonds for that. But as I mentioned in the previous clip, if inflation doesn't go away, we could see interest rates rise much higher from here. For example, the Bank of Canada is shooting for a 2% inflation rate. Our 5-year Canada right now is at 3.45. So how much lower can rates go, given they're already low and you're starting a rate cutting possible cycle here? So we feel if we can get 4.75% on cash right now, as opposed to say close to a 3.5% yield on a basket of bonds from 0 to 5 years, we're going to take the short-term cash at this point. Over the next month, we're going to be contacting clients in an attempt to just tidy up some cash balances. With our permanent portfolio and the interest and dividends that are paid into the account, cash can build up. And one of the things we're going to do is add to equity through what we believe is the best sector to be in right now, which is commodities. Specifically, oil and gas and agriculture right here, we think make a lot of sense. Given the possible war outcome later this year, the supply chain still hasn't come back from the COVID lockdowns. And with de-dollarization that's taking place with the BRIC countries, it's quite possible we could be in for a major commodity rise. So adding to the 20% equity in the permanent portfolio would be adding a little bit to oil and agricultural, and you'll see our reasoning. We're going to do specific portfolio reviews for every client, and you'll be seeing from us in the next month or two what we'd like to do with the account. So just making it a little bit more heavy in equity and hopefully trying to ride a trend that is now firmly in place, which is higher commodities going forward.